Imagine working tirelessly for years, watching your company's stock soar, and celebrating the day your massive block of equity finally becomes yours. But when you log into your brokerage portal to admire your hard-earned corporate reward, you instantly discover that nearly half of your shares are gone. Your first instinct is panic, making you wonder if a sophisticated hacker compromised your profile or if the stock market crashed overnight. The truth is far more systematic, as your hard-earned corporate equity has collided directly with an automated fiscal mechanism. This hidden tax protocol treats modern equity incentives completely differently than long-term investments, catching even seasoned corporate professionals off guard. If you close this video right now, you will continue to let this automated tax routine quietly drain your net worth every single cycle. Stay with us for the next few minutes as we decode the exact structural gears that are actively vaporizing your paper wealth. The fundamental mistake most high earners make is assuming that their restricted stock units are protected by low-tax capital gains rules. In reality, the exact millisecond the vesting clock hits zero, the fiscal system completely ignores the fact that your reward is stock. Instead, the entire market value of those vesting shares is legally converted into ordinary income, immediately triggering top-tier supplemental withholding. To satisfy federal and state regulations, your brokerage firm is legally forced to execute an immediate sell-to-cover transaction. This means they instantly liquidate up to 37% of your brand-new assets at the current market price to pay the tax bill. This automated liquidation effectively cripples your compounding wealth engine before it ever has a chance to generate long-term momentum. The structural pain deepens because the standard automated withholding rate is often capped by default at a flat 22%. If your actual marginal tax bracket is 32% or 35%, you are unknowingly accumulating a massive tax underpayment liability. This hidden deficit quietly builds up in the background, setting you up for a devastating penalty-laden surprise during next April's filing season. But why do so many high earners let their remaining shares sit untouched, exposing themselves to even more financial danger? The answer lies in the endowment effect, a psychological bias that causes us to overvalue assets simply because we own them. This mental blind spot is often intensified by a powerful loyalty bias toward the very company that writes your paychecks. By leaving your vested shares fully concentrated in your employer's stock, you are violating the golden rule of wealth preservation. You are tying both your monthly salary and your entire investment portfolio to the performance of a single business entity. If that single company faces a sudden market downturn, you risk losing your primary job and your accumulated wealth simultaneously. Exposing the hidden engineering of modern consumer capitalism and tax systems is exactly how you protect your hard-earned wealth. Upgrade your financial intelligence right now by subscribing to Economecha and activate the notification bell to master asset accumulation. To truly understand how this mental trap plays out in the real world, we must compare two completely different financial paths. Imagine tracking two corporate executives over a strict 5-year horizon, both starting with the exact same vesting scale. Executive A succumbs entirely to the endowment effect, keeping 100% of their remaining vested shares tied up in their employer's volatile stock. This decision is driven by a deep sense of loyalty, a psychological bias that convinces professionals their own firm is always a safe harbor. Executive B treats every vesting event as a clean cash deposit, immediately converting the remaining 63% into broad market index funds. By doing this, they neutralize the threat of single-stock vulnerability and insulate their hard-earned wealth against sudden corporate-specific downturns. Then, the unpredictable happens, as a sudden industry shift or regulatory hurdle hits their company, sending the stock price plunging by 40%. Executive A watches years of hard work evaporate in days, while Executive B remains completely unaffected, their wealth safely preserved. The mathematical contrast between these two trajectories is a stark warning that keeping concentrated stock is a gamble, not an investment strategy. It is the classic trap of placing all your eggs in a single basket, where your current livelihood and future wealth are identical. To build true, lasting financial resilience, You must learn to detach your personal emotions from your corporate equity dashboard. To break the emotional paralysis of the endowment effect, you must actively deploy a highly specific scientific environment control skill. This mental override tool is known as the cash transformation framework, designed to bypass your brain's natural cognitive bugs. Ask yourself this objective baseline question tomorrow morning. If my company gave me this exact amount in pure cash, would I buy this single stock? If your answer is a definitive no, then keeping your current concentrated holding is a psychological error, not a rational wealth strategy. The solution is to establish an automatic rule to liquidate your corporate shares the exact moment they vest, without hesitation. By automating this transfer, you completely bypass the emotional friction that prevents most corporate high earners from diversifying their portfolios. But what about the immediate tax gap that threatens to trigger massive underpayment penalties from the IRS next April? You must proactively log into your corporate benefits portal tomorrow morning and cross-reference your automated withholding rate against your marginal bracket. If your corporate withholding is stuck at the standard 22%, but your real income bracket is higher, you are facing a massive tax deficit. Manually adjust your estimated quarterly tax payments immediately to eliminate any devastating penalty-laden surprises during next spring's tax filing season. This systematic approach turns your volatile corporate benefits package into a predictable, high-powered engine for generational wealth building. You are no longer reacting to sudden tax shocks or market dips. Instead, you are actively dictating the terms of your financial future. Mastering your money is not just about earning a high salary, but about understanding the psychological triggers that control your wealth. When you align your psychological defaults with automated fiscal discipline, the system can no longer optimize against your hard-earned progress. Take control of your financial destiny right now, secure your compounding wealth, and subscribe to Economecha to outsmart the system.